Well, welcome back to the Conch Economist. I'm Merle Dembath, and today we're going to be talking about buying gold, specifically buying gold on the dip. Now, this is information for you. This is not an investment advice, so please consult with those who you trust and who know you before you go out and buy any type of investment. But many of the things that I'm going to describe for you today, I own or have owned in the past. I currently am not buying gold. I don't think we reached bottom, but that's just my personal opinion. But in any event, gold's been on quite a tear recently, prompted by a number of international concerns and domestic concerns as well. So let's take a look at the various ways that you can buy gold on the dip if you were so inclined. This is a recent chart of gold. We can see that it recently touched a high point there of $5,600, and then shortly after that reached a low point of $4,400. It's now trading around $4,700 to $4,800 per ounce. If you're into physical gold, Costco sells these 1 ounce bars from Switzerland. They're very popular and they go off the shelf fast. If you're not a Costco member or prefer not to deal with physical gold, you could go online to ETFs that track gold prices directly. Top ones are GLD, the Spider Gold shares, last sold for around $455, or the IAU, which is the iShares Gold Trust, around $93. The Swiss one, for that extra purity, about $47. They have no yield, they just mirror gold's price minus any fees. If you want more upside, look at the gold miners. They outperform gold in a bull run, but they're riskier and higher volatility and more operational costs and so forth. The two ETFs which I've shown here, which track a number of gold mining firms, GDX, closing around $97 on Friday, and the GDXJ, which is the smaller gold miners at $129, they both have a small dividend. But if you want to get into specific gold miners, Newmont Mining, NEM, is one of the big ones, and it does pay a dividend. B is for Barrick Gold, which pays a nice dividend of 3.7%. The dividend, I've shown you what the dividends are there. And then there's Kinross Gold and Coeur Mining, which is kind of interesting. It does both, it mines both gold and silver. Now for some special situations or tactics. UGL is a ProShares Ultra Gold, which means it moves 2 times the direction of gold. It amplifies moves up or down. Recent price of around $70. It has no yield, but it does have high risk. GLL is an inverse. It's a way to short gold. If gold is high and you think it's going to go down, then you would buy this. It's the same thing as shorting gold. It bets against gold. And it's great for hedging, but dangerous if gold is climbing. So you have to be careful when you use this. The GLDI is a option play. It's based on covered calls. And as a result, it generates option income, which is why the yield here is higher than what you would normally find. These are more advanced, so use them very, very carefully. That concludes our program for today. Please tune in our series on buying a house in 2026. I think you'll find that very interesting. So long for now.